Welcome back. In this video, I want to talk about some simple strategies you can use to save on your monthly mortgage payments or even pay off your mortgage a little bit faster. And I say simple strategies because I'm not going to be talking about stuff like the Smith maneuver or anything like that. And I'm not going to talk about whether investing is better than paying off your mortgage early or stuff like that. I'm really just going to talk about some simple strategies you can use to save some money on your mortgage specifically. Those other topics will be on another video series. The first strategy I want to talk about is shopping around for the best interest rate. Most Canadians will just go to their bank and take the posted interest rate that is on the bank's website, and when their term is up, their 5-year term, they just take whatever the bank is giving them, and you can actually save quite a bit of money by just shopping around. And you can see here on RBC's website, they're offering a 5-year fixed at 4.59, a 5-year variable at 3.95%. Here are the rates on TD's website, 4.94% for a 5-year fixed closed, 4.29% on a variable. On BMO's website, you can see it's 4.86 for their 5-year fixed and a 4.12 on the variable. CIBC has it at 4.1 for their variable and 4.84 for their fixed. So you can see those are already all over the place. And if you go to a site like RateHub or Wawa or something like that, you can see that you can save a little bit of money, 4.04% and 3.4%. And you have to be careful with some of those because there's going to be things where you can't make lump sum payments or increase the payment frequency or anything like that. So you do have to make sure it's the right mortgage for you. What we did to save money, we went to a mortgage broker and she shopped around for us and came with 3 or 4 or 5 different options. And my wife and I would discuss those options and see which rate was best for us. And I've made a little spreadsheet here to show you how big of an impact getting a better interest rate can have on your mortgage. And I've highlighted the 4.59% here. I generally pick on RBC because it is Canada's largest bank, so I'm just going to use their rates. And this is on a $675,000 house that we're purchasing with 10% down. The reason I'm using $675,000 is that the average house price in Canada has actually decreased, and it's now at just under $675,000 at the recording of this video. And so I thought I'd just use $675,000. And you can see at 4.59%, you would be paying about $3,500 per month, and the lifetime mortgage for your $675,000 house would actually cost you $1.1 million. But if you shopped around and let's say you saved yourself 1 percentage point at 3.59%, you can see that your mortgage payments reduce $340 per month, and you save over the lifetime over $100,000 on the purchase price of your house. And if you blindly just accepted, say, an interest rate that's a little higher at 5.59%, 1% extra, you can see that your monthly mortgage payments go up $350 per month, and the lifetime mortgage goes up to $1.22 million. So you're paying a lot of extra money just by not shopping around. Never pay the posted rate on a bank's website. You can always find a better rate out there. The next thing I want to talk about to save money on your mortgage is the amount of down payment you have on your house. And in Canada, if we don't make a 20% down payment on our house, we have to pay something called CMHC default insurance. And you can see here that if we make a payment in Canada between 5 and 10% of the value of our house, then an extra 4% CMHC default insurance goes on top of our mortgage. And if we put a down payment of between 10 and 15%, an extra 3.10% gets added. And if we make a down payment of between 15 and 20%, then an extra 2.8% CMHC in default insurance goes onto our mortgage. And if you pay more than 20% or 20% or more, then you do not have to pay that CMHC default insurance. So what impact does the CMHC default insurance have on our mortgage payments? Well, you can see here, if you put down 5% on a house worth $675,000, you only have to come up with $33,750, but an extra $25,650 goes on to our mortgage. And if you have 10% down, which is $67,500, an extra $18,800 goes on top of our mortgage. And if you come up with 15% or just over $100,000, then an extra $16,000 gets added to our mortgage. And you can see here, if you have 20% or more, then there is no additional CMHC default insurance that gets added to our mortgage. So the larger down payment you have, the less you have to pay in CMHC default insurance. Another option I want to talk about to save you some money is the payment frequency you choose. Most Canadians will choose the monthly payment option, and many will also take the bi-weekly option, but there is one other option out there that can save you lots of money over the lifetime of your mortgage payments. You can see here that if you have a $675,000 house and you put down 10%, I've got the CMHC fees in there as well. And if you make your monthly payments, it's about $3,500 per month. And if you choose the bi-weekly option, you can see it's $1,612. And so basically to get the bi-weekly payments, they take your monthly payments, multiply it by 12 to get your annual payments, and then just divide it by 26 because that would be, there are 52 weeks in a year and you're going to pay it 26 times per year. So really your payments are the exact same as your monthly payments, and you can see that there are no savings on your interest, and it still takes 25 years to pay off your mortgage. However, if you choose the accelerated biweekly option, that changes things a little bit here. So what they do with the accelerated biweekly option is takes your monthly payments and just divided it by 2. And so what they do is they took that $3,500 divided by 2, and it's about $1,750, but then you make that payment 26 times per year. So instead of making that payment 24 times per year, you're making it 26 times per year. So you're actually paying an extra month's worth of mortgage payments. And you can see what it does to your mortgage. In the end, you save $63,884 and you pay off your mortgage in 21.65 years instead of 25 years. So you can see here in this table, let's look at the 10% down again, the monthly payments and the bi-weekly payments over a year. Basically, you're paying the exact same amount for your mortgage per year. But if you look at the accelerated bi-weekly, you're paying a little bit extra, so $3,500 extra on your mortgage each year, which happens to be exactly the one month payment. You're making that extra $3,500 payment over the year, just paid out every 2 weeks, and it actually saves you a lot of money and you can pay it off a lot faster. You can see here that the cost at the end of your mortgage, if you put the 10% down, both the monthly and the bi-weekly are very close. There's a slight difference of about $1,000 because you are making payments a little faster. But if you make the accelerated bi-weekly payments, you're cutting off your payments by $65,000. $65,000 over the lifetime of this mortgage, and you cut off 3.35 years. So you're mortgage free 3.35 years faster, and you save yourself $65,000 over the lifetime of this mortgage. So with my students, I say if you can come up with that extra small amount of payment per month, then that accelerated bi-weekly is really nice. Another thing you can do to save money on your mortgage is lump sum payments. Lump sum payments will always go against the principal. So as your principal reduces, you're going to pay less interest. So let's say you get, say, I don't know, $2,000 back every tax season. Let's say every April you get about $2,000 back. And what do you do with that? You put it directly onto your mortgage. So I can put an extra $2,000 payment every year onto our mortgage, and you can see what happens to our mortgage. We save $37,000 and we pay off our mortgage 2 years faster just by making $2,000 payments every single year. Because an additional down payment does go directly to the principal, when you put the down payment down matters as well. So let's say you came up with $10,000. If you put that $10,000 early on your mortgage, it makes a much bigger difference than if you put it late on your mortgage. I'll give you an example here. Let's say on the 12th payment here, you came up with an extra $10,000, and you can see that you save $19,300 in interest, and you pay off your mortgage in just about 1 year less. But let's say you had that $10,000 and you later on in your mortgage, on say this 276th payment, so near the end of your mortgage, let's see what happens to your mortgage then. You can see you're not even saving $1,000 in interest, and you've only shaved off a quarter of a year. So the earlier you can make a down payment on your mortgage, the more impact it will have on your mortgage. Another thing you can do to decrease your lifetime interest paid on your mortgage is to increase your payments per month. The extra increase in payments does go straight to your principal. So you can see here that I just added an extra $100 per month. So let's say if your mortgage payments were $3,500, but you could afford $3,600 by putting that extra $100 per month on your mortgage. You can see that you save $24,000 in interest over the lifetime of your mortgage, and you pay it off in 23.75 years. So it does shave off over a year just by making those extra $100 payments. And this was something that my wife and I did do. We often got a variable rate mortgage. Variable rate mortgages have been better than fixed rate mortgages 90% of the time. So 10% of the time fixed rate mortgages have saved you money, but 90% of the time variable rate mortgages have saved you money. And so you have different types of variable rate mortgages you can choose from as well. And so if you have the fixed payment variable rate mortgage, if interest rates go down, your payments still stay the same, which is really nice because that extra payment goes directly to the principal. The bad thing about the fixed payment variable rate system is that if interest rates go up, your payments don't go up and you could actually owe more than you originally had when your term is up. So it can be dangerous where interest rates do go up. What you can do is get an adjustable payment variable rate mortgage, and that just adjusts your payments. So as interest rates go down, your payments go down. As interest rates go up, your payments go up. And so we did have one of these, and we were lucky enough that we were in an environment where interest rates kept going down. And what I would do is I would just adjust my payments to what they were previously. So if I was paying, let's say, $1,000 per month, and then interest rates went down and my new payments were $950, well, I just increased it back up to the $1,000, and that extra $50 just happened to go straight to the principal. And as mortgage rates continued to decrease, I continued to pay the exact same amount I was paying so that we didn't actually notice anything. Nothing really changed with our budget or anything like that, but we were able to pay off our mortgage a little bit faster. I hope this video has shown you some simple ways to decrease your monthly payments or pay off your mortgage a little bit faster. I mean, it depends on where you are financially. Can you afford to put those extra payments down for the accelerated biweekly? If you can, it does allow you to pay off the mortgage quite a bit faster. If you've enjoyed this video and would like to stay informed of some of my other ones, please like and subscribe. Have a wonderful day.